The IPO market in the United States is no longer on pause. After years of stagnation, a new wave of public listings is erupting, and it's already creating life-changing wealth for insiders and retail traders who know where to look. But this isn't just a Wall Street rebound. It's the beginning of a larger financial shift few are prepared for. In the first half of 2025 alone, companies going public in the U.S. have raised over $25 billion. That's more than all of 2024 and nearly triple what we saw in 2023. The drought is over. Now the question is, how do you profit from this IPO revival before it peaks? Let's begin by looking at why this wave is happening now, and more importantly, what it signals about the economy's next phase. The Federal Reserve has paused rate hikes and signaled possible cuts before the end of the year. That has reduced borrowing costs and revived risk appetite across the market. Capital is flowing again. Venture-backed startups and high-growth firms that delayed their IPOs for years are now rushing to list while the window is open. But here's the twist. This IPO cycle isn't just about the economy reopening or interest rates dropping. It's about tech dominance, fintech disruption, and geopolitical hedging all converging at once. Take Chime, the neobank that just went public. It raised $864 million in its IPO, priced at $27 per share, and opened with a 37% surge. At one point, it was up over 59% in a single trading session. That debut alone created a ripple effect across the fintech space. And it wasn't just institutional buyers getting in. Retail investors who understood the timing made a killing. But Chime is just the start. AI companies, drone startups, and digital health platforms are now filing S1s at a pace not seen since 2021. One drone manufacturer, Aero, saw its stock more than double on debut. This isn't hype, it's momentum. And momentum is one of the most profitable forces in any market cycle. Yet most investors are still on the sidelines. They either don't trust the market rebound or they don't know how to position themselves for IPO gains without insider access. That's where understanding the mechanics of this cycle becomes your edge. Because unlike in 2020 and 2021, this isn't a retail-fueled mania. This is institutional capital leading the charge, with retail barely catching on. And that creates a timing gap. If you can spot IPOs with strong fundamentals, aligned sector momentum, and favorable float structures, you can front-run the bigger money before it pours in. So how do you do it? What should you be watching right now? First, track the sectors that are dominating IPO filings. Fintech is leading. AI infrastructure firms are close behind. And surprisingly, defense tech startups, especially in autonomous systems and surveillance, are gaining investor interest due to escalating geopolitical tensions. Second, look at the share structure. A lower float with high demand often signals explosive short-term upside. That's what fueled Aero's surge. It had a relatively small float and strong niche demand. Third, monitor the underwriters. When top-tier banks back an IPO, especially in a hot sector, that's a strong credibility signal. Chime's IPO was backed by Goldman Sachs and Morgan Stanley. That mattered. Now here's where the real profit window opens. Most IPOs see a volatile first day, but the bigger opportunity is in what's called the post-IPO drift. This is a period where, after the noise fades, strong IPOs either consolidate and surge or quietly bleed out. Historically, IPOs with strong first-day volume, analyst coverage, and consistent insider holding patterns tend to outperform in the 90-day window after listing, but only if market conditions stay favorable. And that's the wild card, because while IPOs are surging, macro risks haven't gone away. The U.S. national debt just crossed $36.2 trillion. Debt servicing now costs over $1 trillion annually. If bond yields spike or inflation reignites, this fragile optimism can snap. So the strategy here isn't to blindly chase every IPO. It's to time entries with discipline, sector awareness, and strong volume confirmation. For example, if another AI-focused IPO drops with strong pre-IPO demand, credible underwriters, and a reasonable float, you don't need to buy the first candle. Watch the volume. Wait for the second day's setup. That's where asymmetric upside often hides. Another overlooked tactic? Using ETFs that track IPO exposure. Funds like the Renaissance IPO ETF, ticker IPO, provide diversified exposure to recent listings. It's not as explosive as individual picks, but it's a way to ride the broader trend with less risk. This current cycle also reveals something deeper, a shift in how capital markets will operate going forward. Retail participation is muted. Institutions are hunting growth in new areas. AI, quantum computing, and fintech infrastructure are pulling liquidity faster than traditional sectors. And geopolitically, there's pressure building. BRICS nations continue stockpiling gold, which is now trading above $3,340 per ounce. The dollar's long-term dominance is under question, and U.S. equity markets are positioning to absorb capital while global volatility rises. This makes IPOs in dollar-denominated assets even more attractive in the short term. Here's the key. You don't need 100 trades. You need one well-timed entry. One IPO with a clear setup, real demand, and institutional credibility can outperform your entire portfolio. But this window won't last. As more IPOs flood the market, supply will dilute gains. The earlier you position, the better your risk-to-reward ratio becomes. Ask yourself this: when was the last time you studied an S1 filing? When was the last time you set an alert on a listing date? Most people wait for social media hype, but by then, the move is gone. Right now, you have an advantage. You're aware of the shift before the masses. You have the tools to act. You can ride this wave and take profits before it peaks. The IPO market is back. The question is whether you'll capitalize or watch it from the sidelines like most people will. Most media outlets cover IPOs only after the initial move. By the time it hits the news cycle, smart money is already rotating out. Your edge is preparation. Know the filing schedule. Watch the SE's Edgar database. Follow the roadshow sentiment. These are the signals the top traders track. And here's another overlooked angle: options trading. As newly public companies gain liquidity, options chains begin to form. This opens a new layer of opportunity: directional bets, volatility plays, and strategic hedges around earnings. Especially in AI and fintech names, the implied volatility post-IPO can create huge premiums if you know how to trade them. Now let's talk about retail psychology. Many traders are still shell-shocked from 2022's market correction. They missed 2023's AI rally. They're hesitant to trust anything that isn't a mega cap. That creates mispricing. It creates inefficiency. And that's where agile traders win. Instead of fighting for scraps in overcrowded names like Nvidia or Microsoft, smart money is rotating the small and mid-cap IPOs with asymmetric upside. These are the trades that don't just beat the S&P, they outpace it by 5x or more when timed correctly. What's coming next could be even bigger. Several late-stage unicorns in AI, blockchain infrastructure, and biotech are now prepping for listing. If even two of them go public in the next 60 days, it could spark another short-term IPO surge. But remember, the market rewards readiness, not reaction. If you want to capitalize on this window, your preparation starts now. Watch for filings. Study float sizes. Read institutional sentiment. Follow the quiet money, not the hype accounts. This IPO cycle is about more than just profit. It's about positioning. It's a test of who has the discipline to act early and the clarity to move with precision. Most will miss it. They'll scroll. They'll hesitate. They'll doubt. But a few will execute and walk away with life-changing returns. The choice is yours. Subscribe to Wealth Signal now so you never miss a chance to stay ahead of the financial curve and profit from the shifts others overlook.